It's been a really rough week in the financial news and a flat week for the markets. How do things look this coming week? This week we got hit with record high inflation numbers, 9.1% in June. And wholesale prices, the PPI, shot up 11.3%. This was really bad news for the equity markets. If you look at the equity index performances last week for the previous 5 days, Dow Jones Industrial Average closed almost flat, up 0.3% for the week. The S&P 500 closed just almost flat again, down 0.19%. And the NASDAQ 100 closed down 0.32%. I mean, this is basically a flat week full of bad news. That tells me there's a lot of strength in the equity markets. So what drives inflation? Well, two things. Commodities, and within commodities, you've got energy costs. It takes energy to make things and then to move them. Materials cost. Goods require the purchase of materials, and then services require some support from goods, right? They're not just pure services all the time. And then you've got to feed people, so food costs. And then the other thing, the other item, so we've got two things, commodities, and then we've got labor costs. So goods and services both require human labor. Well, let's take a look at least the commodity component, which is a huge part of the CPI. And if we look at this table, you can see commodity prices have been falling. These percent changes are from the previous peaks, and you can see oil down 25%, gasoline down 25%, heating oil down 37%, gold, an inflation hedge, down 18%, copper, which is in everything, in houses, in electronics, in just about everything, copper down 35%, and you can see lumber down 54%, wheat down 42%. All of these are negative and large in some cases. So is inflation really continuing forward, steaming ahead? I'd say no. If you look at this table, commodity prices have been falling. If this keeps happening, the CPI numbers coming out next month hopefully will moderate somewhat. We'll have to wait and see. But I think we've seen the worst of inflation. Now let's take a look at the metrics. But first, let's take a look at the Treasury and gold metrics. Now, why government treasuries and gold? Well, treasuries tell us what the markets are thinking about the direction of inflation and interest rates. And gold is the quintessential inflation hedge. So it's also going to be packed with information about inflation and what it thinks the Fed is going to do in the future. Let's take a look and see what they're telling us. So here we're looking at the buying and selling pressure for IEI. These are intermediate government treasuries. And for those of you who are new, the black line is the price of IEI, and you can see it was falling here and has been trying to rally. The gray line is the buying pressure, and you ideally would like the buying pressure to be above the selling pressure, as you can see here, so that the price is going up. And here's the orange line, which is the selling pressure. And you can see here, it's below the buying pressure. So these are trying to rally. In fact, they've been trying to rally since way before the CPI announcement came out late this week. Now let's take a look at what I would call intermediate long-term government treasuries, IEF. These are 7 to 10 year government treasuries. So again, you can see the price fell here. Selling pressure was moving higher and was above the buying pressure here. And then they have a very nice rally going on. And you can see that the buying pressure not only increased, it shot up here. So people were really dumping a lot of money into these longer term government treasuries. Now, you're going to say to me, well, why are these treasuries going up if that means that yields are coming down, if the Fed is increasing interest rates? Well, here's the thing. The Fed controls the short end, the short duration treasuries, not the long duration treasuries. The market controls the long duration treasuries. So the market, while the Fed's busy raising rates at the short end, the market's saying, we don't necessarily agree with you, Mr. Fed. And they're actually bidding these bonds up. They're moving higher, which means yields are moving lower in opposition. And by the way, this is what ultimately creates an inverted yield curve, which I know everybody says it's bad. It's not necessarily bad. It's just a fact. Now let's go out a little bit longer in duration and look at 20-year government treasury bonds, TLT. Now these, again, price dropped here and selling pressure was increasing, but you can see they've had a very nice but very volatile rally going higher here, and the buying pressure has been above the selling pressure for quite some time now. So this again tells me the markets don't agree with the Fed's view on inflation. Now let's look at gold. Again, earlier I said gold is the quintessential inflation hedge. And you'd think if inflation was going to be a problem, and if the markets felt inflation was going to be a problem, gold would be going through the roof. Well, exactly the opposite is happening. Gold is going down. And you can see that here. You can see it in the selling pressure. Selling pressure was kind of going sideways here and then really took off and went up. And the buying pressure just kind of went down here and stayed down here. So gold is not looking good at all right now. Now let's take a look at the stock market side of things. You've heard probably in some of my earlier videos, I've talked about the fact that when equities are coming off of a bottom, typically the higher risk stocks are purchased first. So investors tend to pile in to the higher risk stocks. Why? The higher risk stocks have been beaten up the most, so they've dropped the most. And when they come up out of the bottom, they come up really, really fast. So there's a lot of profit potential there. And are we seeing that right now? Well, let's take a look. So what I'm showing you here is a graph with the Dow Jones Industrial Average in green, using the ETF DIA, the S&P 500 in light blue, the NASDAQ 100, a little bit more risky, in purple, and ARKK Innovation, even more risky, in red. And why am I showing you this far back? Well, you can see ARKK Innovation bottomed out back here on June 13th. It had a little bit of a rally, fell back again, but this second low is higher than the first one. So this, in technical analysis, is a good thing. You want to see higher lows, not lower lows. Now, what was happening with the less risky Dow Jones Industrial Average? Well, if you look at the green line, it bottomed out here. It had a little bit of a rally and bottomed out quite a bit lower than its previous bottom. Same thing for the S&P 500, same thing for the NASDAQ 100. So why do I say this is good? Well, the Dow Jones Industrial Average stocks are considered less risky. They're the big behemoth, typically value stocks, so they're considered less risky. The S&P 500 is a very broad index, so again, somewhat less risky. And then the NASDAQ 100 is a smaller basket of stocks and more tech and future looking. So there's some innovation in there, but they're more tech stocks. So those are a little bit more risky. And then you have ARKK, which is considered very risky. So now let's look at a just slightly shorter time frame here, where the Dow, the S&P, and the NASDAQ basically bottomed out, and ARKK had its second higher bottom here. And you can see that ARKK has just taken off, and it's handily beating all of these. And if you look at the NASDAQ 100, the purple line, it's also ahead of the Dow and the S&P 500. This tells me that investors are piling in to higher risk stocks, which tells me investors think we may have seen the bottom here. Now let's look at the metrics for each one of these, because this will be telling. Here's the Dow Jones Industrial Average. You can see it fell here, it bottomed out here, and then it's been trying to rally here, although it's kind of having a little bit of a weak rally here. It's falling a bit. But you can see that the selling pressure has been above the buying pressure since way back here. So this is not a good look for the Dow Jones Industrial Average. What about SPY? Well, same thing. It fell here. It's been kind of trying to rally, but kind of falling off here. And again, selling pressure above the buying pressure for most of this time. Now let's look at the NASDAQ 100, a little bit more risky. Again, fell off here, selling pressure above the buying pressure, but you can see the buying pressure rallied above the selling pressure, swap places here, buying pressure above the selling pressure here, and we've had a little bit better of a rally here with the NASDAQ 100. Now let's look at ARKK Innovation. ARKK Innovation, again, had a drop here, but it's had a very nice rally here. Yeah, there's some volatility here, but the buying pressure above the selling pressure, they swap places here, the buying pressure, again, above the selling pressure. So this tells me that there's more buying pressure, more interest in the higher risk ARKK Innovation stocks than in the Dow Jones Industrial Average or the S&P 500. Now, what about cryptocurrencies? You remember people were saying, oh, cryptos are the next digital gold, right? The big inflation hedge. Well, that didn't age so well. So really, it turns out cryptocurrencies are an innovative technology, just like the stocks held in the ARKK Innovation Fund. And you can see here that they bottomed out kind of when equities bottomed out. So they've been really tracking the NASDAQ 100 and the ARKK Innovation Fund pretty well. And you can see they've been trying to rally here. It's a weak rally, kind of going sideways to slightly up. And, the buying pressure has been above the selling pressure, and then the selling pressure has been above, and so on. So they're kind of trading places here. So this is kind of muddling along here and not really going much of anywhere. Now, the longer it does this, the bigger the move is going to be when it either goes up or it goes down. We'll have to wait and see how that breaks out. But that's what I see in cryptocurrencies right now. Right now, I'm long cryptocurrencies, but I won't be hesitant to get out of the way if they start going the other way. So what does all this mean potentially going forward? Well, to me, it looks like inflation has peaked, at least for now, and we've seen the worst of it. But the metrics are telling me we may very well have seen the bottom in equities, especially in tech and innovation. I'm Calvin Rose, and thank you for watching Invest Smarter today. If you like this video, please hit the like, subscribe, and notification bell so you won't miss an upcoming episode of Invest Smarter. That's all for now. Hey, thank you for watching. If you enjoy these videos, there's several ways on Patreon for you to support the channel and access exclusive content, including special posts on the markets, educational materials about how to select investments and manage your portfolio. And at the investor level, you'll have full access to our natural selection stock rankings so you can evaluate individual stocks or market sectors that fit your investment style. Check out the link at the pinned comments below, and thank you for your support.